Okay, good afternoon, everyone. We're going to go ahead and get started with our program today. Our topic for this Women in Ags program is risk management options. Our speakers today are speakers with Capital Farm Credit. We do ask that you go ahead and keep your audio and your video off. It just helps with bandwidth. This program is also going to be recorded, so we will be able to those will be posted to the Tarrant County YouTube page for later viewing as well. So with that being said, Hannah, I will turn it over to y'all.
Well, thank you, Jacqueline, and good afternoon, everybody. I'm Lynn Golston, VP of Sales with the Insurance Service Group here at Capital Farm Credit. We appreciate the opportunity to speak today about risk management, utilizing crop insurance products to mitigate some price volatility and some weather uncertainty that we all know is out there. I'm going to be joined by some of my team members today. In the room with me here in Lubbock, David Spradlin, Jenny Black, the director of our insurance service group, Greg Lance, Hannah Whitaker, Jared Flores. And you'll get to learn a little bit more about these folks during the presentation. One thing that we can certainly clear up right now, if you have specific questions as we go through the presentation, please utilize the chat box. And at the conclusion, we'll also have some information where you can reach out to us individually, and we'll certainly welcome those conversations as well. So let's take a quick look at our agenda. We're going to talk a little bit about who we are at Capital Farm Credit. We're going to talk about what is risk management and specifically what it's not. It might be a little easier way to define it. We're going to look at some difference in products. There are kind of some distinct products associated with risk management. Some of these are pretty popular in Texas right now. A lot of them have historical tools that we use to help us kind of take some of the guesswork out of that decision process. These tools are going to provide us with historical look back, some graphs showing overall performance of the product itself, and some anticipated outcomes. So they do a lot for us. Specifically, we're going to be looking at pasture, rangeland, and forage, livestock risk protection, and then we're going to dive into something that's a lot more complex and a lot more challenging at times, and that's going to be the multi-peril crop insurance, or commonly referred to as row crop. And when we talk about row crop, crops like cotton, corn, and wheat. Then we're going to look at the private product market, crop hail, and we'll have a little bit of discussion there, and how these products can often be used to supplement your base coverage. And then we will conclude with looking at the state of the Texas crop insurance industry. Who is Capital Farm Credit? Our mission, we are our largest ag lender in Texas. We are a cooperative. If you are a lending customer, you're a member owner. We've served farmers, ranchers, and rural communities for more than 100 years. We entered the crop insurance risk management business in 2014 and have continued on in that field and that space since 2014. We offer crop and livestock insurance in Texas and surrounding states. Our mission to provide reliable credit, financial services that enable our members to achieve success. Our vision to be a partner of choice and basically to offer not just lending, but related services that will help you and sustain you. And our values of commitment, trust, value, and family are very core to everything that we do at Capital Farm Credit. This is a look at our chartered territory. Everything in blue, as you can see from the northern plains all the way down to South Texas. This provides us a very comprehensive look at the different regions of Texas with the different crops, with the different growing conditions, and the different challenges that those regions provide. We are also able to write in the counties that are not blue and also neighboring states. We're committed to serving all producers. We're not a one-size-fits-all operation. Regardless of size and scope, we are there to provide service and support. We have agents located throughout the state. We have a very knowledgeable and professional processing team located in Hondo, Texas. The ladies there do a fantastic job of processing our policies and getting that to our member companies that we write with. And our experienced team is always willing to help and support. What is risk management? Well, some things that it's not. It is not a cash windfall. It's not a guaranteed payment each and every year. It's not something that we would recommend that you jump in and jump out of. Most of the operations that we have seen that have benefited the most from a risk management program have remained in the crop insurance program over several years. It's really hard to outguess the markets, and it's really hard to outguess Mother Nature. So risk management, in our view, it's a plan. It's a plan and a strategy to keep your operation growing, protected, and sustainable. It's important to develop that strategy and to protect your operation. So that's going to involve a lot of people at the table. Involve your insurance agent, your lender, other financial professionals, so everyone can understand the direction you're going from where you are to where you want to be. It's essential to understand a few things when we start talking about risk management: your break even, your margins, your yields. All of these will lead to the decisions and the options that you have. I'm now going to turn it over to one of our relationship agents, David Spradlin. David specifically is going to talk to you about one of those analytical products that I mentioned, pasture, rangeland, and forage. So, David?
Thank you, Lynn, and thank you, Women in Ag. My name is David Spradlin. I grew up in Seminole, Texas on a small cotton farm. So far back that multi-peril crop insurance wasn't even really used or very limited. Crop hail was about the only risk management tool you had, and the other risk management tool was water. If you planted it, you had to harvest it. I started in crop insurance in 2005 in Seminole, Texas, and I moved to Capital Farm Credit in 2024. Part of the reason for moving to Capital Farm Credit is because of Capital Farm Credit's goals of having great relationships, face-to-face interaction, teaching, coaching, becoming a integral part of our customers, farmers and ranchers, in their risk management planning. We want farmers and ranchers to be successful, and I look forward to being a part of helping and improving the lives of the customer base that we serve. I'll talk to you about pasture, rangeland, and forage, or known as PRF. So what is PRF? This policy is based on precipitation, or the anticipation of rainfall. So we're going to start out with a slide looking at seasonal precipitation outlook. If you look at Texas, probably 1/10 of Texas is in the white. And that's showing basically that part of Texas has the largest opportunity of hitting its normal rainfall averages. So the rest of Texas is in or below what the normal rainfall will be or could be. And this policy covers the actual rainfall. If you're in the coffee shop and somebody says PRF or pasture, rangeland, or forage, they're probably not going to say those words. They're going to say that drought insurance. Part of that, that's not what it's called. It's not drought insurance because it insures moisture. But we're in a common sense era of right now. And if you look at Texas with a map that's a chart that's released every Thursday, the majority of Texas is in something called below normal, abnormally dry, moderately drought, severe drought, extreme drought. You get the picture. So pasture, rangeland, and forage. What does it protect? It protects hay and the livestock producers against the loss of forage due to lack of rainfall on acres used for grazing and haying. When you don't have rain, you have less grass to eat or products to eat, and that's what we're insuring. How do you insure it? Well, you choose between 2 up to 6 different 2-month intervals, which every 60 days, in which the precipitation or the rain is important to the operation. How do you qualify? Many ranchers can qualify. They don't have to have a yield. It's based off acres, and there's no minimum of acres. You can choose to have hay insured or grazing insured. Grazing if you have ownership in the livestock on the acres grazed. Cool thing is, you got a sales closing date on 12/1, so we have plenty of time to get ready for that sales closing season. And we'd love to have an opportunity to personalize a program for you. Pasture, rangeland, and forage. The rainfall index of NOAA, I'm from Seminole, so y'all can read the rest of those, that long National Oceanic Atmospheric Administrative Climate Prediction Center. All right, just today, for today's conversation, I'm going to say NOAA. The data for the grid is where the property is located. Your insurance payments are determined using NOAA data for the grids and index intervals you choose to insure. When the final grid index falls below your trigger grid index, you may receive an indemnity or a loss payment for lack of rain. Coverage is based on the experience of the grid, not on the individual farm or ranch or a specific weather station. It's the average rainfall, or they have a really long formula that figures out the actual rainfall for the entire grid. Simple, plain process. You don't have to turn in a notice of loss. You don't have to call, say, I got held on. It's a, what is that called, Lynn? When you do something with numbers and rhythm, a mathematical formula that tells you have a loss. There's no adjuster needed, and it's no notice of loss initiated by the insured. It's in grid. So what's a grid? A grid in Texas is going to be a imaginary set of lines or lines laid out by NOAA that are 12 by 12 miles. They start at the equator at 17 miles. So as the Earth's surface gets narrower or shorter, or the grids get smaller as we go further north. How does it work? You can insure up to 90% of your average rainfall based on the 70-year average rainfall. If you've chosen 90, anything under 90 will trigger a deficit through your PRF insurance. That's on that 60-day interval in that grid would initiate a payment. We'll give you a couple examples of grids. This is Reagan County, grid number 13315 on grazing. The green is really good for the insureds. The red is where the insureds paid premium. 5 years out of 20, the insured paid premium. 15 years in Reagan County, the insured received premium paid for and some gain on the actual loss. Got an indemnity check. Go to the next county, Coleman County, as we go further east into Texas. You've got, again, 5 years that you paid premium and 15 years where you received money from your loss of not receiving your average rainfall. Part of the value is set by the rainfall that's in those grids. So like in Reagan County, you've got $13.20 an acre on grazing And in Coleman County, the grazing value is $23.70. So as each grid, each county has a different value of your grazing and haying, and that's what you're insuring it for. One more, I missed one part. So you have a production value, and you get to choose how much of that $23.70 you want to insure. You can insure up to 150% of it, or down to 60% of it. Your level of coverage is from 90 to 70, and you can insure 90% or the numbers below, up down to 70, and that's how you get your premium for those acres. When you become a customer of Capital Farm Credit, after your policy's been written and insurance liability is attached, we will contact you, help you set up a mobile app, which will give you the ability to view grids in the U.S. It also gives you the ability to look at your specific policy and your specific grid, and you can actually track when you are going to get paid and when you're not, but you get to keep an actual track of how much rain has fallen or been accredited to your grid. It's a very good policy for ranchers to help supplement feed costs or having to send them to the feedlot to feed cattle when it doesn't rain. We would love a chance to show you an individual proposal. The next person up is Jared Flores, and he's going to be discussing livestock risk protection.
Thank you, David. As he said, my name is Jared Flores, and I've been with Capital Farm Credit for a little over a year now. Prior to Capital Farm Credit, I was an ag teacher for 11 years, so appreciate ag extension and just what you do for the ag industry as a whole. When I was looking to get out of ag education, I wanted to stay in agriculture, and in a way, I found another avenue to continue to be an ag teacher in the form of crop insurance and livestock insurance. I'm officed out of Lubbock. I travel. I guess my territory extends to Bowie, Texas, and then back over to Dalhart. And I'm also licensed in the neighboring states. Livestock Risk Protection, or LRP, is a price risk management tool to help cover against a declining market price. Producers may choose a variety of coverage levels and different insurance periods to correspond with their sale times or market weights. It's available for feeder cattle. Feeder cattle are more of your stocker or cow-calf operations. Fed cattle are more of your fats or your feed yard cattle or swine. Today, we're going to look through stockers. LRP is a subsidized put with no brokerage fee. The subsidies vary from 35 to 55%. The subsidy is based on coverage levels, and like anything else, the more risk you're willing to take on, the bigger the subsidy will attach to the insurance. LRP premiums are due at the end of the feeding period, and there are no minimum head numbers or no requirements for a certain poundage during the feeding period. So we are allowed to ride up to a maximum 225,000 head per year. LRP, like I mentioned earlier, is a insurance to help protect you against the declining market. So how is your floor set? How is the price set? Prices are set based on the CME Feeder Index Board. The board settles around 3 p.m. every day, and they use an average weight of 700 through 899 pound steers. How is the floor or loss determined at the end of the feeding period? At the end of each endorsement, the USDA will use the CME feeder index that I talked about earlier and they will also use a 7-day weighted average from 12 states, 12 sale barns. So Texas, New Mexico, Missouri, Iowa, all the way up through the Midwest. So they'll take a combination of those two and compare that number with the floor that you set. If you're a visual learner like I am, let's kind of talk about how it works by using our quoter. We use the BOSIC Analyzer tool, and it is exclusive to Farm Credit and Capital Farm Credit. It's what we use. It simplifies the insurance, in my opinion. It's one of the easiest quoters to follow that I've seen in the market. We allow access to this particular quoter to all of our producers. So let's start. I mentioned earlier that we're going to use stalkers today for our example, and we're going to look at steers weight 1. Weight 1 steers are a target weight range of 100 pounds to 599 pounds. If you are a producer that typically markets your steers at a higher weight, they would fall into the weight 2 category, and that category weight range is 600 to 1,000 pounds. So you may ask, what does weight have to do with it? The weight is the anticipated weight that you plan on selling your calves, either for contracting or single sale barn or private treaty. Once we determine the weight range of what we plan on marketing our cattle at, we will determine how long it will take to get there. LRP is unique in the fact that it has different endorsement links to fit your operation. On paper, LRP is scheduled to have feeding periods of 13 weeks to 52 weeks. However, one option may not be offered the next day that's offered today. So yesterday, the market or the LRP program allowed for a 47-week policy. So it didn't quite stretch to 52 weeks. So after we determine our weight range and how long it's going to take to get there, then we will decide on a coverage percent. And so as I talked about earlier, the more risk that you're willing to take on, the higher the subsidy. So if you're one of those that fit in the category of I want the very top coverage, then you can expect a 35% subsidy attached to the premium. So that leaves you with the remainder of the premium. So let's talk floor price now. The projected floor price in my example here, so here's weight 1 for a 13-week policy. The expected floor price was $293.76. So once we kind of figure that number, or we've got that floor price established, then we figure out how much of a coverage we want to take. So we're going to use 100% coverage just for simplicity purposes. So our floor price that we can lock our cattle in at would be $293.76. And the premium, and this is all based on cut weight, so it's going to cost you $6.38 per 100. And so once you subtract that, essentially our net guarantee is our coverage price minus our producer premium, which is $287.38. I talked about earlier about how an endorsement floor price is settled by using the CME cash index and the 12 sale barns from 12 states on a week-long average. They're going to take their number and compare it to the net guarantee. Where producers have questions is, okay, so my net guarantee is $287. What if I go to the sale barn and I sell my cattle for $260 per 100 weight? LRP is strictly the CME cash index and the sale barn weighted average combined. So in other words, we don't care where you sell your cattle, how much you sell them for. We're strictly going to go look at the board price and compare the floor that you set versus where the CME feeder index and the 12 sub barn average together hit. If they hit lower than your floor price or your net guarantee, then it's going to trigger an indemnity. And I have an example on the next page. Okay, so in this example, our coverage price or our floor price was $269.15. We used a weight 2 steer at 800 pounds, which results in a coverage level of $2,153.20 per head. The premium is $63.84 per head. The estimated ending value, and that value is the CME feeder index and the weighted 7-day Shelbourne average of $251.20. The difference in the two is $17.95. So we're going to take that number and times it by the amount of head to equal our total indemnity. So we can expect an indemnity check of $7,180 with a net guarantee of $3,988 after minusing your premium. This is a whole lot of information at one time, and there's a whole lot of other stuff to kind of cover, but for time's sake, we would love to visit with you. We've got agents all across the state, and this LRP tool is not just for large producers. It fits guys on a smaller scale all the way up to our larger feed yards.
Jared and David have gone through some of these analytical tools, and before we get into the multi-peril, are there any questions in the chat box or anything that has popped up, Jacqueline?
Not at this time. You guys are good to go.
All right, well, we will turn it over to another one of our great teammates, Jenny Black, to talk to us about multi-peril.
Good afternoon. My name is Jenny Black, and I have been with Capital Farm Credit for 5.5 years. I grew up in a small farming community in Littlefield, Texas, where my dad is now a retired cotton farmer. I have worked at the Farm Service Agency and then went on to work at a crop insurance agency for 7 years before coming to work for Capital Farm Credit, where I work in the insurance service group as an insurance account agent, helping small part-time farmers and landlords with 500 acres or less with their risk management needs. So how does multi-peril crop insurance work? It is a tool to minimize your risk when you experience adverse conditions or low yields to help the inevitable. Farming is unpredictable, and by having crop insurance, it is an added tool to help minimize the risk when a crop loss or disaster occurs. MPCI provides production and revenue protection. It helps protect your annual production and revenue and gives you more flexibility in maximizing cash flow. Crop insurance is designed as a safety net to minimize your risk. It will provide you the maximum amount of benefits for the amount of money you are paying. Crop insurance is federally subsidized, and it is subsidized by the level of endorsements you choose. MPCI provisions, including premium costs, are set by the federal government. So what does MPCI cover? It insures over 100 crops, including your basic common row crops such as cotton, corn, grain sorghum, wheat, grapes, and pecans, and many more. You can find a list of all the covered crops at the Risk Management Agency website. It also covers certain perils. The multi-peril crop insurance covers the loss of crop yields from natural causes, including drought, excess moisture, freeze, disease, insects, wind, hurricane, and hail. So the coverage and price levels. You can choose from several coverage and price levels to manage your risk options. We will help you devise a coverage plan according to your specific business needs and risk tolerance. Options will be specific to county and crop, and we will help you choose which crops you would like to cover, which coverage level from 50% to 85%, and if you have your own production information, we will use it to establish your production base for coverage. You can choose from yield protection or revenue protection. Based off your production history, there are several unit structure options to set up the policy. It is the insurable acreage of the insured crop in the county. So there are several different unit structures. Basic unit is determined by crop, county, and share. Optional units is determined by section equivalence. So 640 acres makes a section. It is determined by separate farm serial number, tract field, and irrigated and non-irrigated practices. Insuring fields on a section basis where each field will stand on its own regardless of how another section performs. If you have a loss on one section, it will not impact the loss on another section. If you have sporadic production from field to field, optional units is a great option. Then we have enterprise units. That is determined by insuring fields on a county basis where all the acres of a crop in one county are all lumped together for loss purposes. All the planted acres of the crop in the county must average below your guarantee to have a payable claim. The coverage is less expensive than an optional unit, and you can purchase higher coverage levels for the enterprise units for the same cost as optional units. If you have crops that have similar production, enterprise is a great option. You can also insure optional endorsements, such as supplemental coverage option, enhanced coverage option, and stacks, which I will explain those in a couple of slides. So what is yield protection? Yield protection helps protect yield loss. This is done by taking the average of your crop yields and ensuring a percentage of your average crop yield. The crop and yields that you have produced in the past are known as your actual production histories, otherwise known as an APH, your previous crop yields. You must always have between 4 and 10 years in your database. If you don't have any history, you will receive 4 county T yields. The county T yield is based on the growing conditions in your county and will vary from county to county. As you create your own yield history, it replaces the county T yields. Prices are constantly changing based on the market. To keep the price relevant to the market, there is a discovery period to determine the price of a commodity each year by taking the average of the daily close on the Board of Trade for approximately 30 days. A projected price is then established. Revenue protection. Revenue protection protects against yield loss and changes between the harvest price and the spring price. There is a discovery period, but also there is a harvest price that is discovered during the harvest season. Revenue protection protects if the price goes down the time you would normally be selling your crop. When your price goes down from the projected price, the bushels or pounds you produce are calculated at the lower price, which will be harder to reach your guarantee, resulting in a greater chance of receiving an indemnity payment. If the harvest price goes up, it is still protecting your farm price fluctuations. If the price goes up and you have a bushel or pound loss, those bushel or pounds will be counted at the higher harvest price, resulting in a higher indemnity payment. Then we have several optional endorsements that you can also add to your baseline policy. One of those is called Supplemental Coverage Option, otherwise known as SCO. It is an area-based plan for selected crops, including cotton. It follows the base policy's protection, yield or revenue. Coverage begins at 86% of the expected revenue. Coverage ends when the base policy's coverage begins, and producers may purchase SCO along with the ECO. The ECO is an enhanced coverage option. Like SEO, it is also an area-based policy for selected crops, including cotton. It follows the base policy's protection, yield or revenue. Coverage begins at 95% or 90% of the expected revenue. Coverage ends at 86% of the expected revenue. So there could be a gap in coverage if you don't purchase the SEO. And producers may purchase ECO along with SEO. Then next, we have a stacked income protection. It is also area-based plan only available for cotton. It provides coverage for a portion of the expected revenue for your area. Coverage level is customizable by the producer. It offers a maximum coverage band up to 20% above underlying coverage, which is 90% to 70% of the expected revenue. And please keep in mind that these are area-based, which is county-based. It is not based on an individual's coverage. Federal crop insurance follows a yearly cycle during which insurance coverage begins. Production and acreage reports are filed, and insurance ends. All dates are set by the USDA, and some are specific to individual crop policies and regions. When a loss, there's also a claims process. And when a loss occurs, you will notify your crop insurance agent of the loss so they can file a notice of loss with the insurance provider. An adjuster will get in touch with you to evaluate the crop loss, conducts appraisals, and finalizes the claim. Depending on the extent of loss, you may receive an indemnity payment. Next, we have several important sales closing dates. The spring crops for South Texas was January 31st. The Upper Gulf Coast, Blackland Trail, and Brazos Bottom areas are February 15th or February 28th, depending on your county or crop. And South Plains and High Plains is coming up March 15th. Fall crop sales closing date is September 30th. Don't miss these deadlines. It's super important to start early, to start gathering information and start visiting with an insurance agent. Crop insurance can feel complicated, and our dedicated and knowledgeable team is here to help you through the process. Completing your application, selecting the best coverage for your options, submitting claims, and the billing. Why are the deadlines so important? Well, there's no agency changes, no policy changes, so changes to crop coverage levels, and no extensions, unlike operating loans. And we need to, again, allow enough time for customer and operation introductions, paperwork, including Farm Service Agency communications, risk tolerance, needs discussion, quotes, and more. So crop insurance and MPCI selections you choose will also work closely with the Farm Service Agency. In order to insure your crops with the MPCI policy, you will need to register your farm with the farm number with your local county FSA office. You will report ownership structure for owned land, cash lease, or share crop, and you will certify your acres each season. This can ensure you're eligible for many programs, and these services are free. You will sign your farms into the Title I Farm Bill program, which is a federal program of either a selection of ARC or PLC. ARC is an area risk coverage, and it pays when area revenue falls below 86% of the ARC revenue guarantee. And PLC is price loss coverage, and it pays when the market year average price falls below the PLC reference. Again, as you make these choices, we can have conversations with the insurance agent for the selections you choose. The difference between multi-peril crop insurance and other insurance products. You have the freedom to choose a crop insurance agent that helps you through the whole process. Our team of subject matter experts have a detailed knowledge of different crops, commodity prices, and industry changes, with quick responses and are available to producers. Our insurance administrators are a dedicated team to turn in notice of losses and submitting claims timely. Adjusters are involved during the claims process. Our dedicated team at Capital Farm Credit are your trusted advisors to help navigate you through all the steps from beginning to end. Communication with the producer is critical throughout the entire year and during each crop cycle. How do you get started? Share your operation with a knowledgeable agent. Helpful information to be thinking about is a cropping plan, cost of production, how the crop will be utilized, and type of production record you use. You also need to involve communication with your local FSA office. And we will review multiple quotes that provide coverage to meet your goals. And we will take the time to get to know you and your operation's financial situation to choose the best coverage to suit your needs. And then lastly, you'll sign your application before sales closing date. And again, it's super important to start having those lines of communication open and start very early and not wait till the most last part of the sales closing dates. And again, we are here to help devise a plan for all your needs. And now I'm going to turn it over back to Lynn.
I want to thank Jenny and David and Jared. Now that we've got your head really spinning, you can see there's a lot of complex decisions, a lot of things to think about when you're doing risk management. You can see the difference between a lot of the analytic tool-supported products, more complex agent-assisted products, and we'll even talk about these private products that are crop-hail. But no worries. Through the entire process, through any one of those avenues, we're here to help. We're going to quickly look at crop-hail private products. If we haven't given you enough acronyms this afternoon, we'll give you one more. An AIP, that is an approved insurance provider. Those are the companies that have contracted with the government to implement the crop insurance program. So when we talk about a private product, these are products that are not subsidized by the federal government. These are basically company-specific products. So there's always going to be a difference in products, rates, availability. They protect against hail and fire. They can be supplemental to the multi-peril policy that you're writing. They can be a standalone, which means I can write a crop hail policy without having a multi-peril policy. And they're available during the growing season. So just a quick blurb on the private products. Insuring Texas. And again, I think it's important that we take a look at the overall Texas market. As you can see, $32.2 billion contributed to the economy. Texas is probably the biggest premium producing state for crop insurance in the United States, with well over $2 billion of available premium. Farmers paid in $770 million for insurance coverage, and that we paid out, the industry paid out over $2.7 billion in losses. So you can determine from there, from premium in and lost dollars out, the math is not working as well as a lot of the companies would hope it would work. When we talk about these AIPs, when I started in the business in 1989, there were over 20 companies that were doing business of some fashion in Texas, either with private products or some form of multi-peril or named peril. We'll look at that chart in just a minute and we'll see how that market has increased. But every one of those companies is looking at their strategy for Texas. There may be certain products that companies may offer in certain regions in Texas and may not offer in other regions in Texas, simply based on the loss exposure and the current weather conditions that they're seeing. Our mission is to serve producers and to partner with the best AIPs that we can find. And basically, your long-term sustainability and customer service is paramount with us when we decide to partner with these companies. We partner with 4 of the existing companies out there: Rain and Hail, Great American, RCIS, and AgriSampo. And if we look at where those companies align in 2024, of the top 5 companies that are writing crop insurance in the United States, livestock, multi-peril, private products, all things included, we contract with 4 of the top 5 companies. The one thing that we always will do is we will always take a look at the end of the year at how these companies align with our mission to provide the best customer service possible. We have access to every one of the AIPs that are on the board, but we simply want to make sure that those companies, if we sell a policy, those companies align with us to make sure that we service that policy correctly and effectively. And that's always going to be our goal. Again, we're going to provide personalized service for the producers and the landowners to utilize your best risk management solution. We have crop and livestock insurance management tools available to help you protect your income and your savings. And again, we have an experienced team, and we're going to make sure that we offer our services to be engaged, to be connected, and to basically talk about your plan and how we can offer options for that plan to be successful. Our ultimate goal is to always keep you on the farm and ranch. We've kind of brought everything to conclusion. Again, I don't know, Jacqueline, are there some questions in the chat box?
I think you've got everybody kind of thoroughly confused that they're going to have to absorb everything at this point.
Well, some days we have to absorb a lot too. So you're in good company, because we face that concern some days too. But I would end this way. If there are some specific things that you're thinking about and maybe not sure quite how to ask that question, or a day or two from now, something pops up and you'd like to get an answer to, please reach out to us. We'd love to have those conversations, and we can really get down to an individual level as to particularly your farms, your situation, your plan, and we would be glad to do so.
Well, wonderful. Thank you, Lynn, and thank you everybody for who presented today. Great information, a lot of information. I know I'm going to have to go back through this recording several times myself just to absorb a bunch of it. But thank you for everybody that has joined us today, and this will conclude our program for today. Please be looking for an email. Again, as I stated at the beginning of the program, this was recorded. It will be posted on the Tarrant County YouTube page as soon as I can get it edited, hopefully by tomorrow. Lynn, I'll make sure that your group also has a link to this as well. If y'all would like to share it with anybody, you're more than welcome to with that as well.
Yeah, that'd be great. We really appreciate it.
Perfect. And then also everybody that is participating and who is registered for this program, when I send the link out for this video, I'll also be sending out a link for the quick survey question for us as well. That just helps me out from the extension side of being able to bring more informative programs with what you're needing to the platform. But again, everyone, thank you for joining us and on this very cold Thursday afternoon, and let's hope it gets a little bit warmer. But with that being said, we'll go ahead and conclude today's programming. Thank y'all again.